morning and welcome to Charting the Markets on Friday, the 10th of November 2023. Asian equity markets dropped overnight, and so did US futures as the Fed Chair Jerome Powell basically left the door open for potentially another rate hike to be seen in December, as he said that the central bank is basically focusing on tackling inflation, but he cannot categorically say that the peak of the interest rate cycle has been hit yet. And also we saw a 30-year bond auction in the US go quite badly, which led to bond yields in the US rising again and pushed equity markets lower. Now, this comes obviously after a 8 to 9 day spell of gains for US equity indices, which have risen between 5 and 6%. So the strongest gains we've seen basically since the beginning of the year within a week, last week. And it's normal for markets after such a strong rally to correct. And also, I'll show you that in a minute, they did so around key resistance areas. But before I do, I'd like to have a look at the FTSE 100. And you can see here on the daily financial bet that we rallied yesterday in line with US equity markets, but then basically came off again, and earlier this morning are now falling back to yesterday's lows. And this happened on the back of basically also the British economy stalling in the third quarter of this year, with GDP for the third quarter, preliminary GDP, I should say, coming in at 0% versus an expected minus 0.1% forecast, and a second quarter GDP figure of 0.2%. Now, from a technical perspective here, if we look at the FTSE 100, if we were to fall today through yesterday's low at 7,363, which does look to be likely at the moment, well, then we could be heading back down again towards the 7,300 area. And below there, we've got some really, really important support. And that support is made up of the late October low at 7,258. And then below there, if I zoom out here, you've got all this support going back to March of this year between 7,228 and 7,204. That is the key support area, which needs to hold in the course of the next few days and weeks for us to be able to basically have another attempt to the upside. And I expect that to be the case because I see the correction we've seen since September as an ABC 8 wave correction in terms of a corrective move being made within this wide sideways trading range we've been in basically since June of this year. And I wouldn't be surprised because of seasonality and equity markets usually rallying into the end of the year, us basically heading back up again towards the red line here, the 200-day simply moving average at 7,613 over the coming weeks. But as I say, for this to happen, this key support area needs to hold. Now, talking about the US markets, and as you can see here, we've had basically 6 consecutive days of gains for the S&P 500. And then yesterday on this daily financial bet, we came to within a whisker of the mid-October high at 4,398, which acted as resistance. And obviously the trigger for the S&P 500 coming off again was this comment by the Fed Chair Jerome Powell, that he basically couldn't guarantee that there wouldn't be any more rate hikes in this cycle, and also the disappointing 30-year bond auction in the US, pushing US yields higher and equity markets lower. So it is quite likely that we will see some profit-taking kick in later on today as well, because it's the end of the week, and those investors who made quite a nice percentage gain, the highest, as I said, since the beginning of the year in one streak here, could basically just cash in some of their profits. Now, what could happen, excuse me, sorry, is that we could slide back to the mid-August low at 4,337, and that together with the late June low at 4,328 could act as a support area going forward. But given the strength we've seen since the end of October lows, it looks to me pretty likely that any short-term correction will not be of long duration and should actually stay above that breached September to November downtrend line and also above the red line here, the 200-day simple moving average at 4,263, before we then at some stage rally above not just with this week's high, but also the mid-October high at 4,398. Once that happens, or if that were to happen, we could then basically head back up again towards the September high at 4,540 and perhaps even go all the way back up again towards the July peak at 4,607 with regards to the S&P 500 before the year is out. Another index I'd like to look at is the Russell 2000, the great underperformer out of the US equity indices, still being down by about 3.5% year to date. What we can see here is that we also had a very nice acceleration to the upside, take us to 1,773 last Friday. But since then, the corrective move lower that we've seen just kick in for the S&P 500 and NASDAQ 100 yesterday already began on Monday here for the Russell 2000, which includes the US's 2000 largest stocks. And you can see here basically that we are sliding now back towards the 1,600 area and 1,650 area. And basically the key support area to watch out for here with regard to the Russell 2000 is this area between the October lows at 1,642 and the lows going back to September and October of 2022 last year, down to 1,631. So this support area needs to keep holding for us to have a possible reversal to the upside. Now, if that were to take place in the days ahead, we would not only have to take out this high made last week of 1,773, but also break through the August to November downtrend and ideally rise above this mid-October high here, which was made at 1,791. The US dollar remains quite strong and again rallied slightly yesterday on those slightly hawkish comments by the Fed Chair Jerome Powell. And if you look at euro dollar, you can see the impact this has had on the currency pair, with it sliding yesterday back down again towards the orange line here, the 55-day simple moving average at 106.44, which has basically supported the currency pair over the course of this week. And we have Christine Lagarde, the ECB president, speaking later on today at 12:30. Maybe that will help the euro dollar stabilize her speech. We'll have to see what she will say with regards to the European Central Bank's monetary policy going forward. And from a technical perspective here, basically as long as we remain above that orange line, the 55-day simply moving average, and more importantly, the mid-October high at 106.39, the current retracement lower after this strong upsurge last week is probably just a minor correction in a medium-term, slightly bullish trend. Why is it slightly bullish? Because for one, we have broken through the July to November downtrend line last week and closed above it. That is positive. Second reason is that we've risen above the 24th of October high at 106.95 and also closed above that, telling us that we've probably bottomed out here. And thirdly, we've now seen 3 consecutive higher highs and higher lows on this euro dollar chart since the early October lows at 104.60. So further upside is probably likely to be seen once this corrective move is over, and that could then take us back up again towards the red line here, the 108.03 level, and also towards the July low at 108.34. Now, earlier this morning in the UK, the third quarter preliminary GDP data came in at 0%. So basically growth in the United Kingdom flatlined in the third quarter versus a rise of 0.2% in the second quarter. And on that news, you had the pound sterling slip slightly. And you can see here the euro versus the pound sterling has been rising for 4 days and is on track for 5th days of gains and is heading back up again towards its October high at 87.54. Now, if that were to be exceeded, we could then first of all retest the 1st of May low at 87.60, and above there we've got a whole resistance area around sort of the 88 mark, going all the way back up to 88.75, the April high of this year. And as you can see here, we can basically see very clearly that we've had the sort of bottom formation in euro sterling take shape. And now that we have risen above these highs made in July of this year at 87.01, and also above the high made at the end of September at 87.06, it looks to me as if we are now leaving this sort of bottoming formation and are heading back up again towards the 88, 89 area with regards to euro sterling. And when you look at the British pound against the US dollar, you can see here that we have risen back up to the red line here, the 200-day simple moving average. I did so earlier this week on Monday and were capped by it at 124.28 and have since come off again. And what we can see here is that the July to November downtrend line now, because of inverse polarity, could act as a support line going forward. And that means it is currently at around 121. Yes, it is 121.34. That could act as support going forward. Now, obviously, that support line is less important than the previous lows here, the late October low at 120.70 and the early October low at 120.38. That's the key support area which needs to hold going forward for us to have a reversal pattern confirmed. Now, from a technical perspective, it looked as if it was confirmed last Friday because we closed on a daily chart closing basis above the mid-October high here at 123.37. But since we've come off again since then, it isn't really confirmed yet. So what I would like to see is another rise above that high, 123.37, also ideally above the high seen earlier this week, or 124.28, in which case we should then overcome the red line, the 200-day simple moving average, and head back up again towards the high seen back in mid-April, early June, the low seen late June, and also in mid-August. And these come in between 125.46 and 126.17. Now, I'd like to have a look at the oil price because the price of oil has come off quite drastically by about 6 to 7% over the last few days, as weak data out of China basically led to demand worries. And as you can see here on the daily financial bet, we have now not only fallen through the early October low at $81.21, but also through the late August low at $77.60, and also the 200-day simply moving average here in red at $77.99, all of which is bearish, and seems to indicate that this is not just a three-legged corrective move, but probably part of a third wave to the downside in terms of Elliott waves, and would indicate that the oil price could actually slide much further and reintegrate the May to June sideways trading range it traded in back then, between $74.70 and the $67 mark. So for the time being, we basically dropped all the way down to $74.92 on this daily financial bet on Wednesday, and have been trying to hold above there. But basically, provided we stay below that 200-day simply moving average, and more importantly, the late August low at $77.60, further downside looks to be likely with regards to the oil price. And these levels here act, or should act, if retested, as proper resistance, because they were important support in the past, and now because of inverse polarity, they should do the opposite. So the oil price is likely to remain subdued in the days ahead because of that. Let's look at the price of gold, which has also been drifting lower over the last week or so. We hit a level of $2,009 per troy ounce at the end of October, and that was a level last traded at in May of this year. But since then, we have come off as the US dollar continued to strengthen and are approaching the red line here, the 200-day simple moving average at $1,935. Now, so far, we've held at this support area made up of the early and late September highs between $1,953 and $47. As you can see here, yesterday's low was made at $1,945. But unless we have a very clear reversal to the upside, which doesn't seem to be the case at the moment, it is more likely that we will actually slide further and also test this red line, the 200-day simple moving average at $1,935. Now, if that were to give way, the next lower downside target potentially is the 55-day simply moving average, $1,925. And then below that, we've got really good support going all the way back to the June lows between $1,901 and $1,885. So that is a possible downside target area for the price of gold. And when you look at resistance with the gold price, we have resistance at the 1st of November low at $1,970 per troy ounce. But whilst below there, further downside looks to be more likely than any upside reversal. And last but not least, I'd like to look at US natural gas. And as we can see here, natural gas prices have also come off very steadily over the last few days and have fallen for 5 consecutive sessions and are now for the first time in a while falling through the September to November uptrend line. And yesterday we just marginally closed below there, and today we still trade below there. So that to me indicates that it's quite likely that we will not only just retest the 55-day simple moving average here in orange at $3.10, but most likely also retest the August high and the September high between $3.05 and $3.02 in the days ahead. And then we'll have to see whether we can hold in that support area. If not, we could then also slide further towards the June high at $2.93. But let's see what happens next week. But here we can see that we formed a top formation. And what is interesting also is that that top formation was not confirmed. Basically, the top formation was confirmed. The higher high was not confirmed by a negative divergence on the relative strength index when you had the lower high being made here on the oscillator, whilst the higher high was made on the actual underlying asset, which in this case is the US natural gas price. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on X. My handle is @AxelR_IG. Have a lovely weekend.